Welcome to The Explainer. Most people look at the stock market and just see this one massive chaotic game. You open an app, you click a button, and you just kind of hope the line goes up, right? But what if I told you that is actually a complete illusion? It turns out we're really watching two completely different sports being played on the exact same field at the exact same time with entirely different rules. So today, we're going under the hood to separate these two very different paths of wealth creation, investing versus trading.
Okay, let's dive right into this. We're going to break our journey down into four key areas today. First, the investor's ecosystem. Second, the trader's arena. Third, we'll do a head-to-head clash. And finally, we'll wrap up with the alpha-beta strategy.
Let's start things off with part one, the investor's ecosystem. This is all about building a legacy.
So, investing is essentially a calm, patient marathon. When you choose to invest, you're really stepping into the role of a lender or a long-term partner in the broader economy. And to run this marathon, investors typically use three core methodologies. First up is value investing. This was famously championed by Warren Buffett. It's basically high-level bargain hunting, finding companies that are trading for way less than their actual intrinsic value. You essentially want to buy a dollar's worth of a company for, say, 70 cents. Next, we have growth investing. This focuses on companies with massive future earnings potential. Think early-stage tech or AI firms, even if they look wildly expensive today. And finally, index or passive investing. This is your classic set-it-and-forget-it strategy. Honestly, watching an index fund grow is about as exciting as watching paint dry, but hey, that's the whole point. You aren't picking single winners. You're just betting on the collective, natural upward bias of human productivity over time.
Now, what's really fascinating about this long-term mindset is that it all boils down to pure math. This is the geometric growth formula. Your future value equals your principal times 1 plus the rate of return to the power of n, which is the number of years. Notice that n is an exponent. Because time acts exponentially here, the sheer length of time you hold an investment mathematically overpowers almost everything else. It even overpowers the amount of money you start with. It's the absolute mathematical proof of that old saying, time in the market beats timing the market.
But here's the catch. The math only works if your psychology actually allows it to. Which brings us to the absolutely mandatory trait of a successful investor, low time preference. This is the psychological ability to delay gratification today for a much larger payout 10 years from now. And listen to this, because it's vital. An investor's greatest risk isn't actual market volatility. No, the greatest risk is their own emotional response to that volatility. I mean, it is incredibly hard not to panic and just hit the sell button when you see a market crash all over the news. But if you do panic and sell, you literally break the math.
All right, let's completely shift our energy now to part two, the trader's arena. Hunting for alpha.
We're leaving the marathon totally behind and entering a high-frequency, active combat sprint. Trading is just a totally different beast. You aren't a long-term partner here. Your objective is to actively exploit market inefficiencies. And this entire trading ecosystem is defined purely by one specific metric: hold time. Over at the extreme short end, you have scalping, where trades last mere seconds to minutes, just to exploit the tiny spread between buyers and sellers. Next is day trading. Here, you close absolutely all your positions before the market closes. This completely eliminates overnight risk, meaning some terrible news can't break while you're asleep and ruin your morning coffee. Then we have swing trading, where you're holding for days or weeks to catch a specific shift in market sentiment. And finally, position trading, holding for months based on huge macro trends, which honestly sits right on the border of investing.
So, the crucial point is, how do these traders actually survive in such a fast-paced arena? Well, it all comes down to the expectancy formula. Traders are essentially probability managers, and here is a totally mind-blowing reality. A disciplined trader can actually be completely wrong 60% of the time and still become incredibly wealthy. I know, it sounds crazy, but if your average winning trade is significantly larger than your average losing trade, the math falls right in your favor. They literally live and die by this risk-to-reward ratio.
To manage these rapid probabilities, traders require some highly specialized tools. Trust me, they aren't casually reading quarterly earnings reports over the weekend. They are staring at level 2 data, reading the live order book to see exactly where giant financial institutions are buying and selling. They rely on candlestick patterns to visualize the minute-by-minute tug-of-war between the bulls and the bears. And, perhaps most dangerously, they use leverage. This is using borrowed margin money to artificially amplify tiny price movements into massive portfolio-making gains, or, on the flip side, utterly catastrophic losses.
Which brings us to this incredibly sobering number, 90%. Statistically speaking, over 90% of retail traders lose their entire capital within their very first year. Just let that sink in for a second. Trading is a literal zero-sum game. That profit you just made on a quick trade, that is money someone else actively lost on the other side of that exact same screen. It is an incredibly hostile environment where you are competing against supercomputers and highly seasoned professionals.
Okay, let's move to part 3, the head-to-head clash, a detailed breakdown. Calling both of these activities playing the stock market is honestly like comparing chess to full-contact rugby just because they both take place on a board or a field. Let's walk right through this comparative clash. Look at the fundamental unit. For an investor, they care deeply about the actual company or asset value. For a trader, the fundamental unit is simply the price chart and momentum. The underlying company barely even matters. Look at the stress level. Investors face periodic stress during major market crashes, sure, but traders face a constant daily grind of stress where every single tick matters. An investor relies on deep research and immense patience to compound wealth over decades. A trader relies on pure reflexes and iron discipline to compound cash daily or weekly.
And this brilliantly illustrates how they have totally opposite definitions of risk. To an investor, risk means the permanent loss of capital, like the company literally going bankrupt. They view simple price volatility as a nuisance, something you just ignore. But to a trader, risk actually is a lack of volatility, and frankly, they love the chaos. Without wild price swings and volatility, a trader cannot make a profit. A flat, quiet market is an investor's absolute comfort zone, but it's a trader's worst nightmare. They also consume news in fundamentally different ways. Investors are hunting for information asymmetry. They want to find a fundamental truth about a company's future that the rest of the market hasn't noticed or priced in yet. Traders, on the other hand, look for reaction asymmetry. Get this, a trader really does not care if a news headline is fundamentally good or bad for a company long term. They only care about predicting how the crowd will emotionally react to that news in the next 5 minutes. Then we have the silent killers, taxes and fees. Investors enjoy massive structural advantages here. By holding assets long-term, they pay significantly lower capital gains taxes, often under 15%, with almost zero commission fees. Traders, though, they face a massive mechanical hurdle. They generate short-term profits, which are taxed as ordinary income, which can be up to 37% depending on where you live. Plus, they are constantly battling slippage and commission fees on thousands of trades. This mechanical disadvantage is a huge reason for that 90% failure rate we talked about earlier.
So, part 4, the alpha-beta strategy. Which path should you actually take?
Well, the answer doesn't depend on what the market is doing. It depends entirely on your lifestyle, your family commitments, your emotional temperament, and what you actually want out of life. Just look at the time commitment required. If you have a full-time job, if you want to spend your evenings with your family, and you just want to retire comfortably, investing is the logical choice. It requires maybe 4 to 10 hours of actual work per year to rebalance a portfolio. Trading, however, demands the screen time, the intense focus, and the emotional regulation of a highly demanding full-time profession. If you try to treat trading as just a casual hobby, the full-time professionals on the other end of the trade will gladly take your money.
Let's move to and see how this builds into the ultimate synthesis used by financial professionals, the alpha-beta strategy. The beauty is you don't necessarily have to choose just one, but you absolutely must strictly partition them. 90% of your wealth is the beta, the core, safe, low-fee, long-term investments that ensure you grow steadily with the global economy. But then there's the 10% alpha satellite. This is a small, carefully partitioned pile of risk capital used exclusively for active trading. It scratches that psychological itch for high-stakes action and provides a chance for outsized returns without ever putting your retirement legacy in jeopardy.
So as we wrap up this explainer today, I want to leave you with a really critical question to ask yourself the very next time you open your financial app. Are you running a marathon or are you running a sprint? And honestly, more importantly, do you actually know which race you are currently in? Because mistaking one for the other is the absolute fastest way to lose the race entirely. Take a hard look at your strategy, align it with your life, and make absolutely sure your mechanics match your goals. Thanks so much for joining me on this deep dive.